We're just going to wait a minute. When it's 6:20, we will begin. I hope you are well. If you are here, let me know. Let me know if you are here. Say hello and let me know. Yes, say something. Let me know you are on because I can't see the people. I just can't see in the chat. Okay, so great. So today's webinar is what we've titled "Be Mortgage Ready," like a masterclass, how you can change from interest in buying a property to actually owning a property through having a mortgage. It's very important that we do this because we meet a lot of clients and some of them have no clue what they are doing. So we want you to stay with us to the end. So because why? Why should you stay with us? Honestly, whether you are buying your first home, so whether you are planning to buy your first home or you're planning a remortgage or you're planning to invest, most people do not fail because they can't afford it. A lot of people have the income, they have everything they need to get a mortgage, but they don't get it because they did not prepare properly. And that's why we are here today to show you how you can change that. Preparations is very key when you are going to get a mortgage. And if this sounds familiar, let me know. I'm not sure if I'm ready, because how do you know you are ready? Is it when you have a good income or when your credit is okay or when you found a home? When do you know when you are ready to buy your own home? What if I'm rejected? How much can I actually borrow? Am I making the right decision even to buy my home? Should I rent or should I actually buy my property? So these are some of the questions that you might be familiar with. The other things are also, so the questions we hear again and again, and yeah, it's good. But know that when you're uncertain, you don't carry on doing anything. You delay the whole process. And mortgages are, I would say, time bound, because when you are retired, where is the income for you to get a mortgage? You can get a mortgage if you are retired, but how is the loan going to be like? Some people end up not buying at all, so they miss the opportunity to buy. And some also make very costly mistakes because they wait and wait and wait, or they apply too early, or something happens and it doesn't help them in the whole process, right? And so if you are here, you are highly welcome. The agenda today, and why again you should stay to the end, is we're going to look at some of the common problems and errors that occurs when you are not prepared or when you do things anyhow, how the mortgage readiness framework works, how you can optimize your credit report, how you can look into your deposit and funding, your affordability, your borrowing power, and look at one or two case studies and action plans that you need to put in place to ensure that you are ready. Yes, are you with me? If you're with me, let me know. Send me an emoji if you're with me, because I can't see you, as I said. So what happens when you apply unprepared, or you apply for a mortgage, and you do not actually prepare? So you have lower borrowing power. Your mortgage, or the amount of it, becomes a peanut because you did not prepare properly. You just did things anyhow, and then you woke up and you said, no, I need to buy my own home, and then all the things you've done are just the wrong things, right? And sometimes you end up buying or having the highest interest rate, So some people would say, "Oh, how come I'm getting 6%? Well, my friend had 4%, or my friend had 3%. How come?" Because the circumstances are different. How your friend prepared is different, and how you prepared is also different. And also, it can lead to delayed life decision. So there's an opportunity for you to start creating generational wealth, right? A lot of us, I always say this, properties can really appreciate in value. Yes, it can go down in value, but the appreciation are more, and it could be the starting point of you generating wealth for your family. One property can be in your family forever, forever, and will keep build. People bought properties 10,000 pounds, and today is worth millions. It could be in your in your generation forever, and it can be the pivot for which you will come out of poverty if you do it right. Yes. And what happens again if you're not prepared is that the lender would decline, because you have done all the wrong things. You've done all the wrong things. Yes. And one thing that we need to be aware of is that mortgage is not just a daily transaction where you you apply for a credit card and that is it, or you apply for a personal loan. Nowadays, if you're applying for personal loans, they don't even ask for your proof of income. They just check if you're applying through your app. They just ask you the amount and check if they will give it to you. And by the next moment, the money is in your account. Nothing is asked. Mortgages are not like that, my dear. It's not like a credit card application. It's a financial position. When you are a homeowner, you are seen differently even from the banks. When you're a homeowner, your credit card limit is even different from someone who is not, right? So when you're a homeowner, it's a position and a status in life. The stability that you get if you're positioned well and you're able to get your home is different. And we have to, or you who are going to apply for the mortgage, it is your circumstance, it is your income, it is your credit, it is you who is going to apply for the mortgage. So you need to take control of the outcome. Make sure that what you are doing is going to yield a good outcome rather than letting the outcome come from the bank. Yes, the bank is the person who would give you the mortgage, but they would base the outcome on what you present to them. And so if you are not positioned properly, they will control the outcome, and the outcome might not be what you want, right? Who am I? Is it the same person? Yes, it is. So my name is Narian. Um, I'm an accountant by profession, but here no accounting is being done here. Today we are talking about mortgages. My qualification is with London Institute of Banking and Finance. I have a certificate in mortgage and practice, and so I can advise on mortgages and protection. However, today we are not advising, we are just educating. I want to make that clear, because the difference between educating and advising is that when you are advising, I've seen everything, you've told me everything, and then I'm basing our judgment on what I have seen. And today, I'm just presenting you with information. So we are not advising, we are educating. So I've been in the mortgage industry for 5 year plus. September would be 6 years, I think. And we have helped a lot of people purchase their homes, from nurses to doctors, self-employed, sole traders, directors. Just mention the occupation. We've met them all. And we've helped first-time buyers, homeowners who want to remortgage their property. We've helped clients build their property portfolio. And sometimes also when some people they own a property alone and they pass on their spouses need to take over their property, and we help these kind of people as well. Some people also are divorcing, they need to split their properties and all of that. So we help all manners of people, from first time buyers to homeowners and all that you can think about. Okay. So this whole webinar is powered by the Rock Financial Management Companies. The Rock is a financial planning or advice firm that specializes in holistic financial planning. So protection, savings, investment, mortgages, in general insurance, pensions, will, trust, equity release. We advise our clients on these as well, right? Now let's get the ball rolling. So it's 6:31. I can see that a few people are still on. Good, good, good. Please give me some motivation in the chat. So we have key property purchase players. That's what I've named it, right? And these property purchase players, you are at the center of it all, because you are the one going to purchase the property. And so the beginning here we have the estate agent. We will go into each of them very soon. We have the estate agent, we have the mortgage advisor, we have the bank or the lender, you have your solicitors, you have the one selling, the seller, and you have the seller's solicitors. And you are at the center of this whole process. So yes, you need to put on your belts, because you are the one going to purchase these properties. Am I what do they call it? Dramatizing? No, that's the truth. So we have the lender. And the lender, the reason why we say lender and not just banks is that a lender can be a bank, it can be a building society, and there are non-bank lenders. Now, a bank, so the non-bank lenders means that they are not banks, they just exist to provide mortgage services. And majority of the time, a lot of clients do not have access to this. There are some lenders who will not accept anyone coming directly to them until they come to us, and then we take them to them, right? So there are non-bank lenders who are there to give you the mortgage. And this is the mortgage, the why you will need a mortgage. Based on your circumstances, you need a mortgage to purchase your home, let's say your residential property. You could also have a mortgage, you've bought a property already, but your interest rate or your bank interest rate is not the best. And there are good interest rates out there. You can move your mortgage from your bank to another bank. So you move in an existing mortgage. It's called a remortgage for better interest rate. Or sometimes people can move their mortgage to another bank to consolidate other debt. So for instance, you have credit card, the interest rate is killing. And so you are paying a lot, and your monthly disposable income because of this credit card or loan or whatever is something else. You can take money from the property you have to pay them, and then you have just your mortgage to be paying. If you are in that circumstance, that you can also do so. You remortgage, or you go for a mortgage to pay other debts. Yes, you can also go for a mortgage to refurbish a property. So you've already bought your property, you think you need an upgrade, the bathroom, the kitchen, and all of that. You can remortgage to improve or refurbish the property. Good, good, good. And then you can also remortgage And that is how you build the generational wealth. You can remortgage, take money out to buy another property. You could do that like buy to let or let to buy, and you have second home. You can buy another residential if your income can afford, or use it to buy a commercial property. So these are some of the reasons that someone will go for a mortgage. This is not the only things. There are lots of things that people can do to get a mortgage. And when you get a mortgage, we have the bank or the lender who issue you what we call a mortgage offer. That mortgage offer is where you can now say, oh, good, I am now, let's say, 60 or 70% through the process. So that mortgage offer contains the agreed mortgage amount. It will have an interest rate. It would have a monthly payment amount. It would have the term, and it will have a fixed period. So these are the basic elements of what your mortgage is about. And so when someone has a mortgage, there's a mortgage amount and all of that. So these are some of the things you would see on your mortgage. Now, the mortgage amount is based on your income. Mortgage amount is based on your affordability. It's based on your age. It's based on the interest rate. So all of this will let them know how much you can borrow in terms of mortgages. And then with the interest rate and the amount of mortgage you have, it would define how much monthly payment you would be paying, right? And then this monthly payment, if you're doing repayment, it has the mortgage you borrowed, and a part is the interest on the mortgage. Know that when you get nobody will give you money for 20 years for free. There's interest. And so there is going to be interest on the amount you borrowed. And every month, if you do repayment, you are paying the interest and the mortgage. So at the end of the term, which is 20 years, you would have paid off all the mortgage. And a lot of people ask, oh, so am I going to pay mortgage for the whole 20 years? Are you going to be renting for 20 years? Yes. If you do not have your home, you would be renting, or you'll be living with family. Let's say you are renting. So far as you are alive, you need a place to stay. So definitely you would be renting. But if you own your own home, you also have the home forever. So you also be paying. It's just the same way, right? So the one thing with the mortgages is that you have the opportunity to pay more towards the mortgage you have borrowed. So although they are saying that 1,005 is how much you should pay them every month, that one is non-negotiable. It's been agreed in the offer. You have accepted it. But you think you can pay £2,000 a month. Once you do that, you reduce your mortgage amount, and the overall interest that you pay is also reduced. And that means that your 20 years would also reduce. Right. Now, with the interest rates, we fix it. Every rate is standard variable rate. Now, I don't want to go into the technical, but let me say variable rates are based on Bank of England's base rate. So the Bank of England would say our base rate is 3% or this or that. And then the bank will top up how much profit they want to get from that, right? And so when the bank realized that as you are coming to stay with them on this mortgage for 2 or 5 years, they reduce it, they discount it, because they know that you are going to be with them for 5 years or 2 years. So standard variable rate typically now is about 6.5, 7, some people 8, some banks 10, and all of that. It depends on the bank and the way they want to make their own profit. But if you stay with them for a while, then they reduce it to come down to maybe 4%. Oh, there shouldn't have been the pound there, 4% or 3% or whatever it is. So that is the fixed rate. So with that fixed rate, you are going to stay with that bank for 5 years. Know that the term is 20. If you stay with them for 5 years, after 5 years, you move to variable rate, but you can remortgage to another bank or stay with them. And those are two different things. If you stay with them, mostly we say you're doing a product transfer or product switch. If you move your mortgage to another lender because the lender has a better rate than your existing bank, then you're doing a remortgage. Good, good, good. If you're understanding it, let me know let me know in the chat if you get what I'm saying. Let me know in the chat. If you have any question, you start putting it there. Once we are done, we'll look at it. If anything I said, you have a question about it, you put it in the chat so that you don't forget. So at the end of the session, I will see it and then we can answer that. But if it's making sense, right? If you are understanding it, let me know. If it's becoming technical, let me know. So mostly with the lenders, when you rent, right? When you rent, there's no big obligation. It's only your rent you need to pay and to keep the property okay. If you're unable to pay your landlord, it's just the rent that you owe them. But if the lender, you are unable to pay the lender 1 month, 2 months, then they start thinking, I gave this person 300,000 and they've not paid 1,500 this month, then other month they didn't pay. Does that mean they can't pay the whole amount? So they begin to question, like, what is happening? Because you owe them hundreds of pounds. And so the lender will not just assess your income, or they just assess the whole transaction, if it's risky or not, the type of person you are, right? Are you someone who keep on top of your payment, or you are not? That is one of the things that they look at. So they also check whether they're giving you that mortgage is going to put you in financial distress. And that is one particular thing that is very important to the banks. Please, 1 second. One thing they are very particular about is putting you in financial distress and assessing whether you are able to make payment of the mortgage till the end of the term. Can someone say type something to make sure that I'm still connected? Okay, so when I say assessment, I mean they are going to check whether the income is sustainable to the end of the mortgage term. They are checking whether you can work till the age that you are stating you can work up to due to the current occupation or role that you have, right? Are you all there? Are you all there? Yeah. So are you able to, they also check in whether you're able to commute from where you are buying the property to your workplace. Because what happens is that is your income basically that you are going to they are going to use to assess your mortgage, your ability to borrow. So if you are not able to pay, or if you're not able to go back to work because of the location, then they have a problem. So a lot of people, yes, for instance, don't want to live in London. London properties are expensive. That means some people are looking at, oh, can I buy in Birmingham? Can I buy in Derby? But your work is in South Kensington. If you move to Birmingham, how do you commute to South Kensington? So that is what there needs to be proximity. So these are the things they are looking at. Are you the kind of person who keep accumulating debt? Or do you have the habit of accumulating debt? Are you the person who are missing payments? You are fighting council tax, you are fighting parking tickets, you are going overboard on your overdraft. They are also asking themselves, is this going to happen to my loan or their loan? And they are also going to check the property, right? So some people want to buy problematic properties that you can't live in. So when you're buying a residential property, it needs to be habitable, and that is very key. Habitable. If you don't do anything in the property, can you live in this property? If it doesn't have a kitchen, forget it. If it doesn't have a bathroom, forget it. If it doesn't have the whole place it's not habitable, it's full of mold, it's full of this, they won't land on the property. Because mortgage is a biggest loan, and the property is the security. So the property needs to be okay. So a lot of people, when they see a property that is 50,000 in the central of London and the whole place is dilapidated, then you know that, please, you have no business going in, unless you're doing an investment property to refurbish it and sell. But if you're going to live in as your residential property, then sorry, no. Okay, now let's come to you. We've gone through the lender, you. So it can be just a male, female couple, can be anybody coming to buy a property. Every successful mortgage comes down to all these things. And one week, if even one of them is weak, it makes the whole thing a bit shaky, right? And so we need to make sure that you are holistically okay. And that is what we do when we meet you as a client. We'll check affordability, and that's what the bank is looking at. They'll check affordability, your income, your expenses. They'll check your credit report, your personal circumstances, and all other things. They will check these. Right. Now, when we talk about affordability, we are talking about income and expense, or income and your expenditure. Please, a lot of people, what your bank balance is not what will determine affordability per the bank. Your bank balance. So if you're on overdraft or something, some people, maybe every month their account is zero or something, doesn't mean you can't get a mortgage, right? Your income, if you're employed, what do they need, or what do we need to see? If you're employed, we are looking at your pay slips. Typically 3 months, 6 months, or something. You're looking at those pay slips. If you are self-employed, you can either be a sole trader or a limited company director. And these two are different people. Sole trader, the requirements are different. If you are a limited company director, the requirements are also different. If you're a sole trader, we are looking at tax calculations and tax year overview. If you're a self-employed company director who owns more than 25% shares in their property, we are looking at tax calculations. We are looking at tax year overview. We are looking at the company financial accounts. Yes, we're looking at the company financial accounts, and we will need the company's bank statement. Now, one thing will come there. One thing that we need to be very mindful is when you declare that you have 100,000 income as a self-employed person, you it doesn't end there, right? Know that when you are doing self-assessment, it's the previous year assessment that you've done. So now we are in 2026. A lot of 2025 assessment is being done now. January, April, May, June, July of 2025. That is the sort of assessment the bank is going to look for. So 2025, 2026. Those are historic incomes. And then you have done the self-assessment to HMRC. Now, what is your bank account saying? Your yesterday bank account or your last month bank account is what is telling the bank that you are still receiving that income. So if you've declared 100,000 to HMRC that in 2025 you had 100,000, and the last 6 months you are just receiving 500, 200, 10 pounds, it means that your income has reduced. And they're going to base affordability on how much you have been getting now, not previously. If you check your bank statement now and it can reflect that you can get 100,000, then they will use the 100,000. I hope that is clear. There are other incomes like state benefit, child child benefits. Yes, child benefits is also there. Maintenance, if you are divorced and your spouse is obliged to pay you something, pension income, universal credit, all of these are there. There are also the ones that reduces your income are your commitments, your loans. So when we see people who want to buy properties and the previous month they've gone for their car and they are paying £500 a month, I'll be like, oh my God, this person did not plan. If you are going to buy a property, they look those debts exist already, right? Those debts, they are there already. And so they would deduct those things from your income before they look at what is left if you can buy a property. Unless you prove to them that you have some sort of savings there that you're going to clear that existing credit card off, then they will take it out. They won't factor that in. So loans, credit card, high purchase, stock cards, buy now, pay later, and all those things, they are commitment they look at first before anything else. And I know a lot of people know that, oh, there's 4.5 cap, and so I just multiply my income by that. People even don't know their annual income. Let me tell you. So how do you even know? And most people even say, okay, my P60 says I had 35,000 income, and so that's my annual income. No, the bank do not see it that way. As I'm saying, P60 is historic income. P60 is income you got 2025, 2026. So 2025 April to April 2026. It doesn't mean that going forward, you're going to get that income. So they need to check your current pay slips to calculate your income. P60 contains everything that you earned last year. So maybe they paid you one-off transportation, it will be there. They paid you one-off something, allowance, it would be there. They refunded food. It's not your income, it will be on P60. So P60 is not reflective of annual income. Yes, it could be those people who did not receive anything aside their basic salary. Yes, they can use P60 as their annual income. But if you receive any tiny bit of other things, it is not annual income. Now, a lot of people multiply that and say, oh, then I can borrow this amount. Now, that cap is the ceiling that the bank, whatever you do, they won't go beyond. Doesn't mean that is the amount of money they are going to give you. It's the cap of where they should not go beyond. Even if you can afford more, they won't go beyond it. That is, and even now, a lot of banks are doing 5, 6 times. Check our video on the previous one. And some of the common errors is a lot of people just stop work and now they are coming for look for a mortgage. Your mortgage, you have monthly payments. So if you don't have any income, how do you go about it? And some people just switch from employed to self-employed. When you are self-employed, you just barely started. You don't have tax self-assessment, so there's no income until you wait. So you need to wait 1 whole year. If even you want a very good bank, you need 2 years. So if you switch from employed to self-employed and you are looking for a mortgage, that is the waiting time. And there are also umbrella companies and agencies and all of that who under-declare PAYE income. And these are errors, right? If you are saying your income is 50,000 and your pay slip is showing that your income is 12,000, they are going to use the pay slip figure unless you declare the other ones. So, and also a lot of people who stage incomes, the banks see that. So these are some of the errors that we talk about. Now, when you are employed, there are people who are employed and they are also doing their side hustle. Now, if you are employed and self-employed at the same time, like this that is shown here, this person, I took this from the internet, by the way, it's not any of our clients. This is pay from employment, 7,000. Pay from self-employment, that profit from land and property. If you rent a property, this is the income you declare. And this person's total income is 47,000. A lot of people also assume that, oh, then my income is 47. No. We need self-assessment here for just the self-employed income of 32 and the UK land and property of 8,000. Pay from all employment needs to be proven by your pay slips, which you have to give us the last 3 months. So if that pay slip is showing 2,000, that is 2,000 the bank is looking at, not 7,000. If the pay slip is showing 30,000, that's the 30,000 the bank is going to look at. They are not going to look at 7,000. So it depends. For pay slips or employment, it is what you are getting now, not what you got last year. Self-assessment, fine. UK land and property, fine. Again, when we come to self-employed, we look at 32,000. As I was saying, if your bank account, last 3 months bank account, is not showing that in a year you are going to get 32,000, that would also be reduced. So for self-employed people, your current bank account is very important, or your business account. And a lot of people miss this. We call it tax year overview when you are self-employed. Now, this is the tax and this is the payment. For every year before, the bank expects that you have paid HMRC. So we are in the tax year of 2025, 2026 just ended. HMRC gives you a period of time to pay that tax off. But 2024, 2025, because mostly self-employed people, the bank is looking at 2 assessments. Some will take 1, yes. So if you just been self-employed for 1 year, don't think you can't get a mortgage. They expect that if you have 2 years, they expect that you would have paid 2024, 2025 tax to HMRC. Credit profile is one of the things as well. A lot of people, when you ask them to bring their credit report, they just say, "Oh, my credit is not good. My credit is so great." The score, they will say, "Yeah, the score." But it is not just the score, it is what is there in the profile. Payment consistency. Are you missing payment? Are you always in arrears? Your credit, your direct debit is always bouncing back, bouncing back, bouncing back? Are you in default? How is your credit behavior? Are you always in overdraft? What's the limit? Are you going over the overdraft you've arranged? Payday loans. Payday loans are like financial distress loans. So those ones is your last resort. Buy now, pay later is fine, but it's not what is going to boost your score. Buy now, pay later just is just 3 months. If you want something to boost your score, it's the consistency of payment, not that 3 months. Then you open another one, 3 months. Because anytime you open, they do hard search on your account. So just one hard search and it's lasting for a year or it's lasting for something is better than just every 3 months you are getting buy now pay every 3 months. Credit card cash withdrawal. So you have credit card, mostly you just use it to buy things. But if you are desperate for cash and you go and withdraw cash from the credit card, it also shows financial distress and it can affect your credit. And then the hard searches I was talking about as well. Most of the errors that we see with credit profile is the focusing on credit score rather than what is in there. So there are people who have been in default or have defaulted on something. Doesn't mean they can't get a mortgage. They can still get a mortgage, but your interest rate is what is different. Overspending on your overdraft. You have an overdraft limit of 1,000, and then you have gone over that to 1,005. Some banks will allow you to go over your overdraft. Some banks will allow it, but it's not something that you should be doing. A lot of people too go for loans all over the place and then they say they are bankrupt. Bankrupt means that they don't have any money to pay in one, so they have to cancel the debt, right? And that is very serious. That is like 6 years wait if you go bankrupt or your interest rate is like very high. And you focus too much on credit, your debt to income ratio. So a lot of people go for high purchase, 50,000, and they have their income is 15,000 per year. Banks see that as quite risky as well. If you're missing payment and you are ignoring your debt, if they write to you to pay your debt, you need to pay your debt. So those are some of the things that can affect the mortgage. Other circumstances also include your age. The age affects the term of the mortgage and it affects the maximum borrowing. That's why we encourage you, if you are young, it's good that you buy your property. If your circumstances does not allow it, that's fine. But don't wait till, your visa status. Those days, if you did not have indefinite, you couldn't get any any you could get only 90%. It was even 75%. Now with skilled worker visa, health and care visa, they have changed they've changed the laws or they've changed their criteria. So if you're skilled worker visa, health and care, spouse, whatever, you can still get a mortgage. I know one lender that is even doing 95% for people, foreign nationals. So this is very important to stay. So you don't need to sit there thinking you are not ready and all of that. And also buying properties that are problematic, as I've said. One of the most element, the fundamental of people owning their homes is deposit. It is what can put people, what do we call it, off buying. And so we say that you need to save, 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 save. And you can also use lifetime ISA where the government tops up the amount that you put in. You can get gifts to be your deposit. Your family has the money, they can gift it to you. If you have other properties, you can remortgage and get money from there as deposit to buy another property. So these are some of the reasons why you can get your deposit. Now, I was talking about the purchase players. So you have a mortgage advisor. When you need a mortgage, the first place you go mostly is your bank. They have advisors there, they will check your everything and they would see if they can give you the mortgage. But most of the time, if your bank criteria does not fit in your circumstances, it doesn't mean that's the end of the road in you getting a property. Because there are some banks I know, they will never lend to anyone on a visa unless you have indefinite or you are British, right? So if you are banking with such a bank, you won't get any mortgage from them. Doesn't mean you can't get any mortgage from anywhere. Someone is also giving to those on visas at even 95%, right? So don't be in your place thinking you cannot get a mortgage. So you can go to a restricted financial advisor. Restricted advisors just advise on or get mortgages from one particular bank or a few banks. But when you go to a whole of market advisor, they have access to banks, building societies, and non-banks lenders who they can advise or get mortgage there for you. So those are the advisors that and we are whole of market advisors. So when you are with us, we research and then get you a mortgage. Now this one, there's a couple who came to us. They were ready, but actually they were not because their circumstances, they were on visa at the time, they were less than 2 years, they had just 5% deposit. But because we knew their circumstances, as soon as we knew a particular bank fits their criteria, we gave them a call and now they have their home. So don't sit there idle if you are not sure you're ready, right? If we know that you are looking and your circumstance doesn't fit any bank at all, we still keep you in mind and contact you when something comes on the market. So who is estate agents are the people that you would buy the property from. So the seller would give the property to the estate agent to sell, and then you will go to the estate agent to buy the property. So estate agents are there to facilitate the purchase, the sale, the marketing, and all of that. And there is often something that we call a chain when you are buying. A chain means that you are buying from me, I'm also buying from someone. So you are A buying from B, B is buying from C, C is buying from D, and all it goes round until one finishes. That's when the other also finishes. So you can keep in mind when you are searching for properties, these are some of the things you're going to see. And one thing that people miss is solicitors. Once you get the mortgage, it doesn't end there. It moves to we call them conveyancers. Not all lawyers or solicitors are conveyancers. There are those who specialize in property law. So they would check the legal side of the property. They will draft the legal document, they would do the contract, they will search the local authority and the environment, they will pay any stamp duties and request the money from the bank. The bank will not give you the money into your bank account. They will give it to your solicitors. Then your solicitors will request your deposit as well, and then pay the sellers, and then it ends there. Then they register the property in your name. So those are that's the duty of the solicitor. So let's just go through the mortgage process briefly. Let's start with the long one here. What do you do when you want to buy a property? One, you need to book an appointment with an advisor. A date is set. You go to the appointment. It could be online. They interact with you, or let me use ourselves. We interact with you, get to know whether you are ready. If we think you are ready, we'll send you documents and some things to sign, and then we ask you to bring all your documents: credit report, pay slips, bank statement, tax calculations, and all of that. And then we search for a lender and apply for what we call decision in principle. Once you have the decision in principle, you can now view properties properly, because estate agents would request decision in principle to see that you are mortgageable, like you can get a mortgage. So they want to make sure that they are not saying, yes, you can buy this property when you can't get a property, you can't get a loan, or you don't have the means to buy. Once you have the debt, we'll send you illustrations based on the loan. We will go through the illustration. The illustration will tell you the monthly payment, the interest rates, and all of that. And then you keep searching for the property until you have found the actual property. You give us the details, we send that to the bank, we send your solicitor details to the bank, we give all the documents to the bank, and then they can also come back to request other things. The bank or the lender will go and value the property, or go and see that the property actually exists and it is worth how much you are buying it. You start filling your solicitor forms. If they are happy, they will issue the mortgage offer, and then your solicitors will take over. So that is how the whole process is. So this one is saying, the one on the left, you get a mortgage in principle, you make an offer on a property, you instruct a conveyancer, you arrange a home buyer survey. The home buyer survey is to check if the property has any problems. That is your cost. You review the property search, you finalize the mortgage, you pay your deposit to your solicitors, and then agree on a completion date, and that is that process. Is it a good time to buy? Well, it depends on a lot of the things that prevents is your age. Properties increase in value as time goes on. So if you say, okay, let me wait the next 5 years, the property you're seeing that is 300,000 today could be 310. So is your income going to increase to be able to buy that 310? That is one of the things you are looking at. So house prices, I'm putting this here. Once you have time, go and watch this video again. In London, wherever you want to buy properties, these are the average house prices. How should I prepare? The first thing is, where do you want to live? What is the property price of the area? That is your starting point. Then speak to an advisor for them to check your documents to know how much you can afford. If you can afford it, then you have a plan on how you can increase your income. So you need an advisor. And so for now, if you still think you are not ready, what we are introducing is what we call a mortgage ready service. Our standard service is that you can book with us 45 minutes. We can go through, you will tell us, we don't take any document until you are ready to be our client. And by our client, it means you are ready to buy your property. If you do not have the means yet, or you do not know what to do, we've seen a lot of people, they don't know whether they are ready or they are not. And so we've introduced the mortgage ready service that we would look at your documents, your credit, and everything, and let you know where you are, what you are doing well, what you are not doing well. And that comes with a little fee, right, for us to do that. Otherwise, you can still book us for 45 minutes. We won't take your documents. We will just interact with you, know where you are and all of that. That is still there. So if you want to book that, you can let us know. Otherwise, you can also jump onto the Mortgage Ready service where we will check all your documents and let you know where you stand now and what you can do better, what you should stop, and what you can do great. So always with a mortgage, if you don't say this is not good, so your home will be repossessed if you do not keep up with payments. Thank you so much for your time. So as I said, we are the Rock. These are our details. If you want to be on the Mortgage Ready service, you can email us admin@therockfmc.com, or you can pick up our telephone number 0203 674 2929, and then we'll send you the link where you upload all your documents. We will meet, and then we will search. We would let you know what you are. If you are ready, we will just carry on and let you know we are ready, and then ask you to go and look for your property. If you are not ready, we'll give you the plan, a plan that you should at least work with to make sure that um, you are on the right track. So thank you so much for your attention. If you have any questions, you can put it in the chat. Any questions? If this session has been helpful, also you can let me know in the chat, and then we will call it an evening. Helpful, let me know if it's been helpful. If you have any questions as well. Okay, I'll wait 3 more minutes. Oh, give me some thumbs up if it's been, oh, it wasn't helpful. So you're not, oh, I'm not seeing it. Give me some thumbs up if it's been helpful. Or if you have any questions, you can put it in the chat as well. Okay, it's been great listening, much enlightened. Thank you. Thank you too for joining. Okay, 2 more minutes to go if you have any question. Hey, are people still on? Are you still there? Let me know. Has it been helpful? Do you have any questions? Okay, thank you to Raw Family Vlogs. Okay, 1 more minute for me to end the live. 1 more minute for me to end it. One more minute. And if you've not followed us yet, you can follow us. You can follow us. And they say hit the subscribe button. Okay, thank you so much for your time. It's now exactly an hour when we started. We hope to see you next month again. Yeah, we'll keep in touch. Bye bye for now. Bye. I still see people on. Thank you so much for coming. Okay, I'm going to end this now. Bye.